Hey, what's happening, guys? Dan Darrow here with another Options and Play video update. This week, I've been trying to go over different strategies that kind of help maybe get like your playbook together for how to operate into the correction or after the correction, how to position for a potential rebound, right? So, I've gone over a couple different ideas, and today I'm going to talk about married puts. All right. Um, Married put's pretty straightforward. Uh, it The definition of a married put is essentially that stock and so say for instance 100 shares of Apple stock are bought, and at the same time one put is also bought. Okay, so 100 shares of stock and then one put, which is the equivalent of 100 shares of stock too, right? And the key thing in that definition there is at the same time. All right, so it's opening the long stock and the put at the same time. Otherwise, if you were long the stock first, so say you're long the stock and then a couple of days later, a couple of weeks later, you wanted to hedge it out, then that would just be a put hedge. Okay, it wouldn't be the definition of a married put. The idea is pretty much the same, but a married put means that the long stock and the long put are opened at the same time. All right. Now you're wondering like why would you want to do this? Okay. Now talking about again, like this is going to involve equity and option strategy, so the combination of both. So not just options. Like I talked about leaps yesterday. That's just an option idea. This is an idea that revolves around being able to trade the stock or buy the stock and options. Okay. So Apple, right? Apple's gotten hit, rolled over. On Monday, it actually traded all the way down to like 212.50 almost, right? So lost about a third of its value in a little under a month. Now you're saying like, okay, like Apple, definitely a name you want to be involved with, right? But at the right price, and maybe hypothetically that right price for you is where it's at right now, like 250. Like that was like the area you wanted to buy, right? For some people, that's fine. You say like, okay, I wanted to buy at 250, so you buy your 100 shares at 250. For other people, though, I mean, that could be a significant portion of their portfolio, and they could be concerned with the overall volatility in the market. And they say like, I'm not sure that Apple's done going down. I'm concerned that if there's like another leg lower in the market, or something happens with Apple's production or the delay in their 5G phone, that Apple could have another material leg lower over the next couple months. So I want to participate, but I'm not really comfortable with like the huge volatility at the moment. So a married put would basically be like the equivalent of like a put hedge. Is you open the stock, right? So you say I want to be long 100 shares at 250, and then you go into the put market, right? And at the same time, you would open. So say like again, like the time frame is going to be important, but say like you think that there should be some sort of resolution to the coronavirus, and maybe like better visibility after the end of May or after the end of June. So just hypothetically, we'll just say June. So that's 3 months from right now. So what you would do is if you bought the shares at 250, right? What you would look at is one of the 250 strike puts. Okay, so you bought 100 shares at 250, and you're looking at one of the 250 strike puts. So those are going to cost about 23 and change. So just a little over 23 points. So what that does is that basically provides downside protection once the stock drops under 250, right? And you laid out 23, so essentially your cost basis would be all the way down at 227, right? So, you have the risk between 250 and 227, and then once it drops below 227, the put should move 1 to 1 with like the stock, right? So basically, like your loss through June 19th through the expiration is basically capped at the price you paid for that put, 23. So what you would say is like you want to be long the 100 shares, but you acknowledge that there could be another leg lower in the market, there could be another leg lower in Apple, and you're not really comfortable with 50, 60, 70 point downside risk. So you look at a married put, that puts a floor on the stock, right, through the expiration of the contract, which is June 19th, right? So for every 100 shares of stock, you're looking at one put. So if you bought 200 shares of Apple, then you're looking at two puts, right? And that's the idea of a married put. So it allows you to get involved, but maybe remove some of the volatility or the downside risk, and that way, you can either sit tight, maybe ride out some of the near term headlines, the near term news, and then if Apple does start to rebound, you obviously participate in the upside. Your risk being like the $23 you paid for the June put. All right. So again, kind of like another idea, opening up the playbook. People definitely they've been asking questions, wanting to take advantage of the market correction. So this is like another idea where you can use options to maybe position. It also involves equity, but still, it's a combination of equity or options. Yesterday was leaps, just strictly options. So there's a lot of different ideas for the people that want to add risk or maybe the people that want to reduce risk. Plenty to look at. So if you have any questions, let me know. I'm happy to help if you need some more clarification on that. Um, if you like these videos and you're looking for more information on options education or more information on option trade ideas, please follow up the link in the description of the video for more information on options to play. Stay safe, stay healthy. We're going to get through this together. Have a great night, and I will talk to you all soon.